If you are trading on a regular basis, you should be aware of whether or not you have gains already. A huge loophole exists right now. We expect this loophole to close. When? Hard to say. Come tax time in a few months. What does this mean for crypto? So if you're in the boat where you have gains, you want to listen to this video because we're going to talk all about tax loss harvesting and how you can use that strategy to reduce or even eliminate potentially your tax bill in a few months from now.
Hey everyone, I'm here with Andrew Gordon, who is a tax attorney and CPA at Gordon Law Group and has been in the crypto tax space since 2014 to talk all things saving money on your crypto and general tax bill in 2023. We're going to be sharing some tips and tricks on how to maximize your upside and save money going into 2024 and have as much of a position as possible to maximize your gains. Andrew, just to kick us off, we've really seen the market see a resurgence in Q4 of 2023 for some people that are sitting here. And I think a lot of us have a positive tax income or are sitting on some gains towards the end of this year that a lot of people don't necessarily know what to do with and also might be unaware of the tax liabilities that actually come with that. What kind of general tips or tricks would you give to some people that are sitting in some of these positions that you would advise on them to take?
In general, you're not taxed just when a NFT or a token you're holding appreciates or increases in value, but you are taxed when you sell, exchange, or trade that token. So if you're holding tokens and they've gone up, you're okay. But many people over the last few months, over the last year, tax year 2023, have sold NFTs or tokens at points where it was at a price higher than when they originally acquired it. And in those situations, they're going to be taxed. So many of you out there, if you are trading on a regular basis or even traded a few times in the last year, you should be aware of whether or not you have gains already, because come tax time in a few months, you're going to then report these gains and you might have a tax due. And why is it important to know that now in December when you're watching this video? And that's because there are still tax planning opportunities that are available, but these are going to go away after December 31st. And the big one is tax loss harvesting, which refers to selling tokens or NFTs at a loss and using those losses to offset other gains. So if you're in the boat where you have gains, you want to listen to this video because we're going to talk all about tax loss harvesting and how you can use that strategy to reduce or even eliminate potentially your tax bill in a few months from now.
So let's say for basic terms, I have $10,000 in short-term capital gains for 2023 so far.
Mm-hmm.
And whatever that tax rate is, let's just say the tax rate on that will be 30%. So if I write that off, if I have a bunch of NFTs that I am sitting on an unrealized loss of, let's say $5,000, if I sell that right now, does that turn my short-term capital gains for 2023 into $5,000?
You hit it on the head. As long as those losses are in the same year as the gains, or those gains are in future years, but right now we're just talking about 2023. As long as you sell those NFTs at a loss before the year ends, you can reduce your gains by that amount. So $10,000 of gains in your example, and then you had an NFT that, say you bought it $5,000 and now it's worthless, trades for a penny. You can then sell that and have a $4,999.99 loss.
Andrew, does it matter if I have, for example, if I bought this NFT over a year ago and I have a short-term capital gain, but a long-term purchase, meaning I bought this over a year ago?
A short-term loss can still offset a long-term gain. And so that's fine. But you may not want to do that. And that's where some tax planning and strategy comes into play, because long-term gains are taxed at approximately half the tax rate of short-term gains. So it may make sense to sell and realize those long-term gains, not offset them with losses, and actually pay the tax, or in fact, no tax at all. A lot of people out there don't realize that if you don't have other sources of income, for instance, you're married filing jointly, you can sell over $100,000 of long-term NFTs or crypto, over $100,000 of gain, and pay no tax. So depending on your tax bracket, depending on if it's long or short term, although tax loss harvesting is a great strategy, it shouldn't be used all the time. It may make sense to actually realize those gains.
What's the difference between a long-term and a short-term capital gain?
So short-term capital gains are taxed at your ordinary tax, which is the same tax rate that applies to other sources of of income, W-2 income, interest, things like that. And so it's your ordinary tax rates. That varies from 0 to 37% on the high end. So it can be quite considerable. Long-term capital gains, on the other hand, are 0 to 20%. And most people end up paying 15%. It's up to about $400,000 in long-term gains that you'd pay 15%. For some people, it's 0% up to even over $100,000. So long-term gains, much lower tax rate. And if you really think about it, 15% tax, not that bad. Yes, tax is incredibly complex, especially when it comes to crypto, even more so when it comes to NFTs. But therein lies actually the opportunity. We can do a lot of things with NFTs and crypto that, for instance, with stocks, well, either don't apply or just not realistic. Here, you could be having NFTs that are selling at a penny, realizing those losses, offsetting gains quite easily with some planning involved.
What are some things that you can do with crypto and NFTs to optimize for tax that you can't do for stocks?
A huge loophole exists right now for crypto, and it's similar for NFTs, but in general, fungible crypto. And that's the wash sale rule. Right now with stocks, if you sell a stock at a loss, you can't buy it back within 30 days and still have that loss on your tax returns. That's considered a wash sale. The loss doesn't apply. However, the way the code is written, most practitioners, in fact, even Congress, don't believe that it applies to crypto because it only refers to stocks or securities. So what does this mean for crypto? It means you can sell a crypto asset like Bitcoin or Ethereum, realize that loss, buy it back the very next day, buy it back a few hours later, and still have that loss. I talk to a lot of clients that say, well, I don't want to harvest my losses. I want to go long. I don't want to be out of these positions. Well, with crypto, you can sell, have that loss on the books for your taxes, and then buy back in a very short period. With stocks, again, it's got to be over 30 days. We expect this loophole to close. When? Hard to say. There have been efforts in Congress, even in the past year. Fortunate for us, it still exists. The law still says stocks or securities, but we expect that this is going to close.
I have a brother of mine that did buy Ethereum at $3,500. So he's sitting on an unrealized loss. He doesn't trade very often. He has short-term and maybe long-term gains on some stocks that he's sold. But for him, let's say he doesn't have any short-term or long-term capital gains at all. Would there be any upside to him writing or taking a tax loss at this? Is there anything for him to write off at all even?
If there are no current year capital gains, the capital losses that you harvest or realize in the current year will offset income to $3,000 a year. Not a whole lot, but hey, it's something. But the more important benefit is that the remaining capital loss is carried forward to future years. And under current law, it's carried forward indefinitely. Why is this important? Well, next year, bull run, prices go up and you have gains. No opportunities to harvest losses, but just gains all the way up. It'll be too late at that point to have taken these losses, and then you'll have some gains that you actually want to offset. So you can carry forward losses, which then makes it, in many situations, make sense that even if you don't have gains this year, to take those losses so that you can carry them forward to future years.
For someone that's like myself, I consider myself more of a casual, not a hyper high-end expert trader. What kind of like general starting out tips can you give to someone like myself?
Depending on your complexity, volume of activity, number of exchanges you've used, it may make sense to use a do-it-yourself software or enlist professional help, a firm like ours. There are many, many different crypto tax platforms out there. One that we work very closely with is CoinTracker, and these allow you to import your wallets and exchanges, identify taxable transactions, and generate reports. But they are, in fact, do-it-yourself, which means you need to spend the time going through everything, and the reports and results are only as reliable as the time you put in to generate it. And a lot of these different taxable events aren't identified automatically. Maybe a withdrawal from one wallet, deposit it into another place, actually a trade, but it just sees it as self-transfers or vice versa. So there's a lot of time involved even in that software. And so for many people, they choose to use a professional firm like ours to generate these tax reports. And for clients, we do this either on an annual, quarterly, or monthly basis, or just as requested. And that way the client has an accounting of what they're holding at any given time and can and make informed decisions on trades.
I want to talk airdrops with you, Andrew, because I think this is a common misconception. My belief, and correct me if I'm wrong, is that airdrops, for example, Blur, which was an airdrop of multiple thousands of dollars that a lot of people got from using an NFT marketplace, that is not a capital gain. That is marked as income. Can you tell me a little bit more about that and some things that you've noticed from airdrop season in crypto? Because it's really heating up right now.
Airdrops and forks, hard forks that have what the IRS would call an airdrop, we all think of a little bit differently as well. This has actually been going on for a few years now. And it's one of the few things that the IRS has issued guidance on. And the IRS says what you had indicated, which is that the receipt of an airdrop or a new token, you receive it, gets deposited in your wallet. That is not a capital gain. That is income. It's income at the fair market value at the time you receive it, or at the time that it becomes tradable or you have control over it. And so even if the price goes down later, and this is important, you receive an airdrop, price goes down later, you still owe tax as of the value at the time you received it. So very important, you receive an airdrop, you don't want it. It may make sense to sell it as soon as you receive it, because if the price goes down, you'll have a capital loss, but we talked about the limits of capital losses against income, only up to $3,000 a year. So smaller airdrops may not matter, but we've seen massive airdrops. Bored Apes, for instance, right? ApeCoin, massive airdrop, tens of thousands of dollars for some people. Price of that drops down. You have income at the value as soon as you received it, say $50,000. Then the price drops down in half. You sell it, got a $25,000 capital loss, but you can only reduce income by $3,000 a year.
I saw on the news, this is unrelated specifically to crypto and NFTs, but I've seen this year that the US government has hired a significant amount to the IRS. And part of the narrative that I saw people talking about, or possibly on the news, was that rich people are going to get taxed, or the higher class is going to get taxed. To me, the reason why the wealthier don't get taxed as much, or why this probably won't affect them as much, is because they have tax experts like yourself to help them avoid these things. So if anything, it's going to come to people that are undisciplined with how they do their taxes, like possibly myself or some of other people that might be listening to this that haven't taken action so far.
Our clients have very successful in avoiding audits, yet at the same time have incredibly complicated and in many cases high net worth tax returns. And so why are they able to avoid audits? And that's through having proper representation and advice to avoid the landmines on tax returns that often throw people into the IRS's crosshairs. And so if you know how to avoid these things, yet also use the tax code to your advantage, you'll be in a much better position overall.
I have a significant amount of NFTs that are literally worth $0 right now. Not only is it worth $0, no one will buy them, right? And they are on Ethereum. For me, like if I list them right now, one of the things that happens is someone needs to go in and buy it, spend Ethereum gas, etc. And that's why we've been partnering with Unsellable, which will buy these NFTs off of you for a penny. Part of what I've been looking at is I've been organizing, and I've been dealing with the pain of paying gas on top of selling these things. But I've done the math and it pays off because I get to write off thousands in losses. The question essentially I'm asking to you is, A, does it make sense to sell these NFTs to Unsellable? When to understand to sell these NFTs, or how to make the call to sell these to Unsellable? And lastly, is Ethereum gas, the gas cost that I pay, is that a write-off as well?
Whether or not you should sell an NFT, for instance, to Unsellable for a penny depends on at least two factors. One of those I can help with, one of those I cannot. The first is what you bought that NFT for, not in Ethereum price, but USD. So if you bought it with Ethereum, what was the fair market value? What was that USD price? And so that is the maximum loss that you can take, what you actually paid for. So it's important to know that price. The second part of it is whether or not you believe that NFT price will go up and will go over the price that you bought it for. That I can't help. That's a financial and investment decision. But ultimately, if you don't believe it will go up, you think that it's the end of the project, then in most situations, it does make sense to sell and realize that loss to offset other gains, either in the current year or future years. But it's not a one-size-fits-all solution, because as I mentioned before, depending on your tax bracket, you may owe no tax at all. You still want to have that first piece of the puzzle. What is your overall gains? What are you holding today? But using a service like Unsellable absolutely makes sense. We've had clients that have shared with us, or we've witnessed a very sad story where they held NFTs at the end of the year that were essentially worthless that they bought for hundreds of thousands of dollars previously and yet had a gain in the current year, but were holding these lost NFTs at year end. And so then when we do their taxes, we had to inform them, hey, you have a big tax bill because of all these gains. And they say, well, I have all these NFTs that were worthless. I lost all this money. It was a bad year. And then we say, well, you didn't sell those NFTs. You're still holding them. Loss is only realized when you sell it. If you can't sell it, most situations, that's not good enough. So a service like Unsellable helps to do so.
What would be the three things that someone can do to become, at least put themselves in a better position to identify what actions they should take from a tax loss harvesting point of view before the year ends?
Spend a couple hours and educate yourself generally about crypto tax laws. We all spend a ton of time listening to podcasts, reading news articles about crypto on online blogs, trying to figure out ways to maximize your investment gains. Well, I can help with tax to, in some cases, increase your gains 30, 40% based on the short-term gain tax rate by just using tax planning. And so spend a couple hours just learning the basics of tax. The second would be having a professional or using a DIY software to go through your transactions and generate tax reports for prior years and for the current year. And that's another big landmine or pitfall is people think, oh, I'm just going to worry about 2023. Your cost basis or what you bought a crypto token for occurred in prior years. You've got to know that information, meaning you need to reconcile the earlier years, generate tax reports, or basically as soon as you started through the current year to have reliable data for the current year. The last piece I would say is have a plan before year end. If it's January 1st and you're calling us and saying, how do I minimize my gains? Oh, shoot, realized I've got $100,000 of gains last year and no cash. What do I do? In many cases, it's too late. Even if you can't get all the crypto accounted for by year end, at least take pause, consider the tax planning opportunities. Maybe there's NFTs that you know are in a loss. See what you can do before year end. In many situations, there are things that you can do or on December 31st to minimize your crypto taxes.
This was fantastic, Andrew. I really appreciate the time. I'm understanding now that this is the time where you save money on taxes. It's not when April comes around, right? Absolutely. This is the time where you can actually take the action, understand where you're at from a gain or loss perspective for 2023, and then understand what kind of actions you can take to save money on your tax bill. And I'm sure that is a lot of people, considering that we have had a pretty nice end of the year pump in crypto and NFTs. So Andrew, thank you so much for the time. Guys, if you are interested in learning more from Andrew or potentially working with him, you can follow Andrew at Gordon Law LTD on Twitter, or go to gordonlaw.com to learn more about how you can work with him or his team on tax planning or working with him in the future. Andrew, anything else people should know about you or your team?
We do all things tax. So in addition to doing the crypto reporting, we also do tax returns and tax planning. So we like to be your one-stop shop for all things tax.